The Federal Reserve just released data, and I think a lot of people are sleeping on this right now. If you have a car loan, a mortgage, a credit card, or student debt, this affects you directly. So it affects almost every single American. Here's what it says: Americans are falling seriously behind on loans, and not just any loans. Student loans specifically are spiking in a way we haven't seen in a while. Now, on its own, that sounds like somebody else's problem, right? Whoever has student loans. But I want to show you why it's not. Because what happens next is part that nobody talks about. So let me back up for a second here. Because on May 12th, the Federal Reserve, they actually dropped their latest consumer credit data, and buried inside of that report with all that data was a measurable surge in what they called serious delinquencies. That means people who were 90 days or more behind on payments. And the number that jumped out the most was student loans. Now, here's where it gets important. We also learned that very same week that inflation climbed to 3.8% in April. That is the highest it's been in quite a while. And for the first time in 3 years, wages are no longer keeping up with inflation. So people now have paychecks that are buying less. Their debt payments have not gone away. And now they're starting to miss their payments. That's a combination that we need to pay very close attention to. All right, here's why this matters beyond just people missing payments on student loans. See, when delinquency rates go up, lenders see more and more people falling behind, and then they get nervous. And when lenders get nervous, they tighten their standards. And that means, well, they raise interest rates on any new loans, they require higher credit scores to qualify, and they reduce how much they're willing to lend overall. And some buyers or borrowers, well, they get told no, and that's that. This is called a credit tightening cycle. And historically, rising delinquency rates lead this cycle by several months. Meaning the people struggling right now are the early signal for what the lending environment will look like anywhere from 6 to 12 months from now. So, if you're thinking about buying a home in the next year, financing a car, even opening a new credit card, the window where they're going to be a little easier on you, that's getting way, way shorter. I'm not saying that the sky's falling. I'm not saying that, you're never going to get a loan. I'm saying that the data is pointing in one direction, and it's better to see it coming now than to be surprised by it later. Student loans, are what we're watching specifically because they are right now the canary in the coal mine. They're representing a massive slice of the American consumer base because we're talking about roughly 45 million people with student loans. And for a period of time, they've been protected by payment pauses, there's been forgiveness programs, and by temporary relief measures. But a lot of all that protection is gone now. Paychecks, they're being just sucked away because the payments have to be made. And younger borrowers are getting hit the hardest because they have all of that, plus increasing rents, plus higher groceries in a tighter job market where they are not making it in ways that older generations are. So when you see these serious delinquencies spike in student loans, what you're seeing is a generation of consumers who are starting to crack under financial pressure. And that spending, or lack thereof, ripples through the entire economy. So what does this actually mean for you? First, if you're thinking about making a major credit card move of any kind at this point, it's better to do it sooner rather than later. You need to lock in your rates and lock in any kind of approvals while the standards are still somewhat loose, right? You don't want to wait for the perfect time because conditions are likely to be tightening. Then you're going to check your credit score. If there are any errors, dispute them now. Work with your utilization if it's high to try getting it down. You want to be in the strongest position you possibly can for any kind of tightening of the credit standards. Then, if you have a variable rate debt, know what the payment looks like if your rates move. Don't get caught off guard, right? We want to be on top of all of this. Finally, just pay attention. Right now is not the time to panic. It's about being aware. The economy usually gives us some kind of signals before it makes any problems for us. And right now, these are signals to look out for. So I'm not going to tell you that the economy is about to collapse. I am going to tell you that the data is real. This is from the Federal Reserve. It is showing a trend that will typically lead to tighter credit. Most people, they don't want to hear about this, and then they'll go down the road and they'll try to apply for something and they'll find out that they can't get what they wanted. So we need to be prepared now and plan now. Now, if you know anybody who's looking to apply for anything and try to make a big financial move, you need to let them know about this so that they are prepared as well. Comment below, are you falling behind on student loans or any loans in general? How are you dealing financially? I want to know. And until next time, have a great day. Remember, think differently, take control, be a